Hey guys, welcome to Tax Planning on the Whiteboard. Last episode we talked exclusively about indirect rollovers, but if you didn't catch it, make sure you watch that one first. It'll give you a good base on the content we're about to discuss. In this episode, we're going to talk about direct methods of transferring tax-deferred accounts such as 401ks, IRAs, SEPs, and Simples. If you want more Tax Planning Whiteboard videos, make sure you click that subscribe button. And as always, a quick reminder, this is not specific information to anyone watching the video. I want you to use it as general information and education only. Please don't implement any strategies you hear without talking to your financial professional first. Now let's go to the whiteboard. Okay, on our whiteboard today, in addition to indirect rollovers, which we discussed last time, there are two direct methods of moving money from one trustee to another. So on our whiteboard presentation today, we're going to talk about simply the direct methods. All right, now, with two methods of moving money from one trustee to another, what we're going to do is we're going to go side by side and just show you the similarities and the differences of these two. So the first one is commonly called a direct rollover, okay? Remember, last week we talked about an indirect rollover. Today we're talking about a direct rollover. So what's over here? What's on the right side of our column? We're going to talk about a direct transfer, okay? Very different than a direct rollover. So we have a direct transfer over here. So the first thing I think we should talk about is let's look at some of the similarities. What do these two methods have in common? Well, the first similarity is that they are both trustee to trustee transfers. Now remember, we talked about last week the indirect method where it is not a trustee to trustee method. There's a middleman involved, and that middleman is the account owner, where the trustee sends the money to the account owner first, and then that account owner has time to put that money into the new holding account. So in both of these situations, a direct rollover and a direct transfer, it is a trustee to trustee transfer. Another similarity is there is no 20% mandatory withholding, okay? None in both of these methods. Now remember, again, in the indirect method we talked about last week, there was a 20% mandatory withholding when coming from an employer plan like a 401k. So keep that in mind. There is no mandatory 20% withholding. And we talked about some of the tax traps involved in the mandatory 20% withholding rule on an employer plan like a 401k that somebody could unfortunately fall into. So be careful with that one. There's also no 60-day rule. No 60-day rule. Okay. Unlike the indirect method we talked about last week, what we have to do is, in the indirect situation, you have 60 days from receipt of those funds. The funds have to be into the new account within that 60-day time period, or else it becomes taxable and possibly an extra 10% penalty if under the age of 59 and a half. In the direct methods, direct rollover, direct transfer, no 60-day rule. There's also no limit on the number of direct rollovers or direct transfers you can do in a given year. Remember, indirect method, you could only do one per 365-day period. There is no limit on direct trustee-to-trustee rollovers or direct trustee-to-trustee transfers. Remember that one. That's an important one. And the last similarity is it's not taxable. Okay? Not taxable. So these are some things that, are similar, that they have in common. What are some of the things between a direct rollover and a direct transfer that are different? What are the differences between a rollover and a transfer? Well, on a direct rollover, what we're referring to here is these are commonly for not like for like accounts. Okay? So an example is not like for like accounts would be a 401k plan, okay, 401k to an IRA. They're two different account types. They're both tax deferred, of course, or pre-tax funded with pre-tax money. But commonly what you're seeing here is we're rolling over from a 401k, a direct rollover from a 401k to a traditional IRA. So they're not like for like accounts. So that's the main difference here. It also could be a 457B to a IRA. It could be a 403B to an IRA. So the important thing here is not like for like. Over here, when we're talking about a direct transfer, these are like for like. So let's use the word transfer when the account types are the same. So example, a 401k to a 401k, trustee to trustee direct transfer. Or how about an IRA to an IRA? Maybe you're changing custodians, trustee to trustee transfer. Okay, like for like. Another difference is, let's write down differences here so we understand what we're talking about. Another difference is, remember I mentioned they're not taxable. Neither of these are taxable. That's something that's in common. However, with a direct rollover, it is a reportable event. So again, the trustee will report that direct rollover, and that is going to be reported with a 1099-R. It's not a taxable event, but it is a reportable event. Where a direct transfer, when you're doing like-for-like accounts, it is not taxable, but it's also not a reportable event. So you most likely, I say most likely because I have seen trustees issue 1099s, but it is not technically a reportable event. So you may not get a 1099 when you do a like-for-like direct transfer, IRA to IRA, 401k to 401k. Okay, so now let's go ahead and summarize what we talked about today, and then we'll wrap up. Okay, let's summarize. In addition to indirect rollovers we covered last time, there are two types of direct methods: direct rollovers and direct transfers. Again, direct rollovers move funds between two retirement accounts, but unlike indirect rollovers, the funds are never in the account holder's custody, nor is there a mandatory 20% withholding, as we talked about with an indirect rollover and transferring from an employer plan like a 401k. For direct rollovers, funds are moved from the trustee of one account directly to the trustee of a second account, where each account is a different type of account. Example, 401k to an IRA or vice versa. Direct rollovers also have no time limit in which the transaction must take place, and there is no limit to how many direct rollovers can be done in a given year. While direct rollovers are not taxable events, they are reportable events and reported on Form 1099. Now, similar to direct rollovers, direct transfers are made directly between trustees of each account. You don't take possession of the funds. But what distinguishes a direct transfer from a direct rollover, though, is that the accounts are like for like. IRA to IRA, 401k to 401k. Direct transfers are not taxable events, but unlike direct rollovers, they are also not reportable events and do not require the submission of a 1099. The key point is that each of the ways to do this, you can move funds from retirement accounts. They have distinct rules associated, so be careful. So guys, I hope this helps clear some things up regarding money movement between retirement accounts. Don't forget to click that subscribe button for more tax planning on the whiteboard videos, and we'll see you next time.